Hey traders, a very warm welcome to you. So we all know about stop losses. We all know we should be using stop losses. We all know the premise behind it is it stops our loss if the trade goes against us. It limits the impact of the damage of a trade that is going against us. But are there any alternatives for using a stop loss? You know, one thing you have which could be a problem when you're trading with a stop loss is that the probability of a market touching something is twice that of the market closing at it, if that makes sense. So in other words, you know, if the market just pings up, the probability of closing there by the end of the day is still 50-50, whereas it's already touched it. So without going and kind of over analyzing this kind of thing, often you probably see this yourself with trading, you can get stopped out quite a lot only to see the market go back in your direction. You know, you're buying this pullback, you have a stop down here, pings you out, goes back in your direction. Now, I think the best thing to do is to try to find the best possible place to put your stop where the trade premise is invalid. And that's why I am always looking for trades where there's a genuine place for the stop. So, you know, if you're trading a double top fake out, for example, you know, the genuine place for the stop is going to be here or somewhere above it, because the premise of the trade is that that's a fake out. It's just having a look above the high, it's sucked a few people in, it's rolling over. If it goes up and carries on moving, the premise of the trade is broken. So to me, that makes sense. And I always try and find setups and strategies where that's the case. But often you can't do that, or maybe it's not part of your strategy, it's not part of the way you want to trade. So what are the alternatives you can do? The other thing you can do is you can use no stop loss, but just control your risk with size. What do I mean by that? In other words, you know, you can trade such a small amount that the market can go against you. So if you're day trading, you can say, listen, I've got an ultimate stop loss of 3 times the daily rate, like a worst case scenario. But within that, I'm just going to trade in and out of my position with a 1 lot, a 10 lot, whatever it may be. And if the market goes against me, you know, I'm not going to close the position. I'm going to either wait for it to come back, or I'm going to add to the position. I'm going to close a bit of the position. I'm going to add a bit more here, close a bit here, wait, come back. Then I might just close it out here. I'm going to just work the position. So not necessarily adding to it. I did talk about adding there, but it's kind of working around a core position. So instead of just leaving it to go down here, you're scalping in and out, maybe adding a bit more, you know, taking a bit off, still got a core, adding a bit more, taking a bit off. On working around, you know, the trade that you've got and trying to make that a better trade. Pros and cons of that, we can see that that's pretty, you've got to be pretty on the ball to do that. Although, you know, I do know a trader who does that, does it very successfully, doesn't use a stop loss, gets in. From time to time, he does get caught out, but he seems to get away with it over the years. You know, is it suitable for his style of trading? Yes. Will he get caught out one day? Maybe he will, but it's probably not going to be enough to undo it, because what he doesn't do is he doesn't add, you know, add and end up with 10 times the position the worst possible. That's not the thesis of adding and trading around a position. It's adding, scalping out, adding, scalping out, adding, or closing that, adding, closing that, and it's working it rather than just adding and hoping blindly for it to come back up. Okay, so that's that. Another one with the same kind of strategy, controlling risk with size, is that if the trade goes against you, you have, in fact, we'll call this number 2, guys, because it's probably really a separate one, isn't it? Number 2 is we have a reassess level. I quite like this, to be honest. I quite like this. I'll show you why. Because let's say, let's use a red pen here. Let's say, for example, you know, the market is going down and we've bought, sorry, let's say we've gone short here, okay? We've gone short and we're wrong and it's pushing back up. Now, obviously with this premise, we probably would use a stop loss, but let's say it doesn't. You know, let's say we've looked at that and we still bearish on that, generally, that trade, that chart, whatever it may be. So what we do is we say, okay, this here is our reassess level. In other words, we're not going to stop out of it, but we're going to look at it and say, is this trade still okay? So, you know, as we've come down, we've pushed back up, we didn't go to low, we've pushed back up here, This is our reassess zone. We're looking at it. You know, do I want to keep it? Do I want to close the position? Do I want to add to the position? What do I want to do? How do I want to work it? With that scenario, you've got a bit of flexibility. You might say, listen, it's crept back up here. My correlated markets are still looking weak. You know, I'm trading the CAC and the DAX is still looking weak, SMI, FTSE, or I'm trading dollar and whatever. I'm not, you know, whatever you make to use to make your decisions. Maybe the daily is looking weak, 15 minutes, a small pullback in a 1 minute, not too bothered. You know, then you can stay with the trade. You say, you know what, I'm going to stay with the trade. Fine, I'm going to leave it. And I'll put a reassess zone kind of up here, and I'll reevaluate. Now, the caveat to that, guys, is that you've got to be sure you know what your monetary risk is on that. There's no point in just reassessing and finding out you've lost 20 times what you wanted to lose. That's ridiculous. There's no point in doing that. The whole objective of this is to not be stopped out unnecessarily on a trade that's still working. It's just kind of ideas and suggestions to do that. But then you could say, you know what, I don't like the look of it. It dipped below here. It's already found some buyers down here. My reassess zone is there. I'm out. I'm not going to trade it. I'm not interested in it. I'm out. And you have to be very disciplined, obviously, to do that. You can't just be keeping it just because you don't want to take a loser. If you have that in you that says, hey, I don't like taking losers, this is definitely not the strategy for you. So a reassess level, I quite like that. I used a hybrid for a while, which was I'd have a reassess level here in my day trading, and then I'd have a do not cross zone. So in that zone here, I would reassess the trade and I'd decide if I wanted to keep it or not. And sometimes I would keep it, sometimes I would bin it, depending on my judgment. And then if it came past the do not cross zone, I'd just close it out automatically, because that I was day trading and I didn't want to lose any more than that based on the strategy I was doing. And actually that worked very, very well. That worked very well because the noise then didn't ping me out. I could reassess it and it was all good. Okay, the last one, guys, is that we talked about with size. The last one is hedging yourself with other correlated markets. This is a little bit more intricate, and this is probably more like a strategy than an actual risk management strategy, although it's possible. So let's say you've gone along the DAX. I'm going to put hedge here. I'm not going to talk about options hedging because that's generally most of us, if we're trading on CFDs or spread bet, we probably wouldn't be using an option as well, but we can obviously hedge with an option. A bit more complicated. Won't go into that in this video. Maybe we'll do another video, but you can hedge. So in other words, if you're long the DAX, okay, here you go, you're long the DAX and it starts to go lower. You might look over and say, oh, look over here, the FTSE or the CAC, probably a better one, is just not quite going lower yet. So instead of selling your DAX and closing your DAX off, you're going to go short the CAC. So you're going to come over here and you're going to short an equal amount or an equal valuation. Again, you have to do that calculation for yourself. It's not necessarily 10 and 10. It's going to be depending on the range of the day and all those kind of stuff. A bit more detail for this video. You're going to short the CAC, making yourself almost market neutral, but trying to capture the fact that this maybe hasn't rolled over yet. And so your thinking is that, yeah, this might be a bit extreme for the DAX. It just got caught out. It's just gone down, spiked through a level. I don't want to close it or short the CAC. And you're hoping that that's going to be a little bit lagged. The CAC will do that. The DAX will kind of, you know, calm down a bit and just relax and reevaluate and reassess and congest and just not go any further lower. The CAC will go lower. You'll be able to cover your short here, potentially taking a little bit of hedge off, funds that losing trade, and you can reassess it. Again, depends on the trade strategy you're using, what you're trying to achieve, but it's something to consider. Alternative to using a stop loss. In other words, you don't have to. I would recommend using a stop loss in most scenarios, most scenarios, but there are guys out there who are not using a stop loss and doing very well. Controlling risk with size, very, very small size, trading around a core, having a reassess level instead of a fixed stop level. They look at it, reassess it. Obviously, they might have a fixed stop level after that, but reassessing whether to keep the trade or not, and then hedging with an opposing pair trade on a very, very similar instrument. So something to consider. The main thing, a caveat here, guys, with all of this is you must be aware of the total risk on the table in monetary value. It's all very well, but at the end of the day, if you're losing more money than you expect on the trade, it's not going to do you any good. So always being sure that you're not going to get wiped out, you're not going to do any damage on one bad trade, because that's just not going to help you out at all. Okay, let me know your thoughts about stop losses, whether you've got any other strategies to use for, or any strategies out there apart from the stop loss to manage your risk. And if you haven't subscribed already, please do so. See you in the next one, guys. Take care. Bye-bye.